Before we begin, a quick and important disclaimer. I am not a licensed financial advisor, and this video is for educational and entertainment purposes only. The information presented here is not financial advice, and you should always consult with a qualified professional before making any investment decisions. All investing involves risk, and you should never invest more than you are willing to lose. This presentation is based on my own research and experience, but you are solely responsible for your own financial choices. You grab your phone in the morning still half asleep, and the first thing you see is a news alert splashed across the screen. Dow plummets 800 points on inflation fears. Your stomach tightens. You feel a knot of anxiety. What does that even mean? Is that bad? Should you do something? Should you check your 401k? Or maybe the headline screams, Nasdaq hits new all-time high. A wave of FOMO, fear of missing out, washes over you. Are you leaving money on the table? Is everyone else getting rich while you're stuck on the sidelines? This feeling of confusion, of being a step behind, is exactly what Wall Street wants you to feel. They thrive on complexity. They want you to think the stock market is some mythical beast, a complex code that only Ivy League analysts with 3 computer monitors can decipher. But that is a lie. A lie designed to keep you from building your own wealth, to keep you paying high fees for advice you could learn yourself. The truth is, understanding the health of the US stock market isn't rocket science. It's a skill, and like any skill, it can be learned. That's the promise of this video. We are going to pull back the curtain. We're going to demystify the jargon and give you the exact framework the pros use to read the market's mood in minutes. By the end of our time together, you will no longer feel that knot of anxiety when you see a financial headline. Instead, you'll feel clarity. You'll feel confidence. You won't just know if the market is up or down for the day. You'll understand the story behind the numbers. You'll be able to answer the question, is the US stock market up today? With the insight of a seasoned investor. To do this, we're going to focus on 3 core pillars of market analysis. First, we have the indexes. These are the big picture scoreboards. Second, the indicators. These are the market's vital signs, telling us about its underlying health. And third, the influences. These are the external forces, the news and events that push the market around. Master these 3 pillars, and you master the market's language. Let's start with the most fundamental piece of the puzzle, the indexes. Think of the entire stock market as a vast, powerful ocean. You can't possibly measure every single drop of water. It's too big, too complex. So instead, we measure the tide at a few key locations. These locations are the indexes. They give us a snapshot, a general sense of which way the entire ocean is moving. In the United States, there are 3 main tides everyone watches: the Dow, the S&P 500, and the Nasdaq. You hear these names thrown around constantly, but most people couldn't tell you the crucial differences between them. That ends today. First up, we have the grandfather of them all, the Dow Jones Industrial Average, or simply, the Dow. When your uncle at Thanksgiving talks about the market, he's probably talking about the Dow. It's the oldest, most famous index, created way back in 1896. It tracks just 30, that's right, only 30, of the largest and most influential blue-chip companies in the United States. These are household names, the titans of American industry. Think Apple, McDonald's, Home Depot, and Coca-Cola. The Dow is like the Hollywood Walk of Fame for stocks. Getting included is a huge deal, a sign that a company has truly made it. Because it's made up of these massive, stable companies, the Dow gives you a good sense of the health of the traditional industrial side of the US economy. However, it has a major quirk. It's what we call a price-weighted index. This is a fancy way of saying that companies with higher stock prices have a bigger impact on the Dow's movement, regardless of the company's actual size. For example, a $1 move in a $200 stock affects the index just as much as a $1 move in a $50 stock. Many experts see this as an outdated and slightly distorted way to measure the market. So while the Dow is the one you'll hear about most on the evening news, it's not the one that serious investors rely on most. It's the celebrity, not the workhorse. That brings us to the workhorse, the undisputed gold standard for measuring the US stock market, the S&P 500, the Standard & Poor's 500. If the Dow is a curated list of 30 celebrities, the S&P 500 is a massive, diverse cast of the 500 largest and most profitable companies in the country. This isn't just a handful of giants. This is a broad, sweeping view of the American economy. It covers about 80% of the entire US stock market's value. When you hear a professional money manager or a financial analyst on TV talking about beating the market, This is the market they're trying to beat. Unlike the Dow, the S&P 500 is market cap weighted. This is incredibly important. Market cap is short for market capitalization, which is just a company's total value. You get it by multiplying the stock price by the number of shares. In the S&P 500, this means the biggest companies like Microsoft and Amazon have the biggest influence on the index's movement. A 1% move in Apple's stock has a much larger impact than a 1% move in a smaller company in the index. This makes perfect sense, right? It gives you a much more accurate picture of where the real money is moving in the economy. If you only have time to check one number to gauge the health of corporate America, the S&P 500 is it. It is the single most important benchmark in the financial world. Finally, we have the new kid on the block, the tech-heavy, growth-oriented powerhouse, the Nasdaq Composite. If the Dow represents the industrial past and the S&P 500 represents the broad present, the Nasdaq represents the innovative future. The Nasdaq is a much bigger index, containing over 3,000 stocks. While it includes companies from all sectors, it's famous for being heavily dominated by technology. This is the home of the game changers: Amazon, Google, Alphabet, Meta, Facebook, Nvidia, and Tesla. When you hear news about the tech sector booming or busting, the Nasdaq is the index that will reflect that story most dramatically. It's also market cap weighted, just like the S&P 500, so the tech giants have an enormous sway over its direction. The Nasdaq is often more volatile, meaning it has bigger swings up and down, than the Dow or the S&P 500. This is because it's packed with growth-focused companies that are betting big on future innovation. It's the high-octane, high-risk, high-reward corner of the market. So let's put it all together. Why does knowing this matter? Because now, you can read between the lines of the news. If you see a headline that says, "Dow sinks while Nasdaq soars," you're no longer confused. You immediately have an insight. You know that the old guard industrial companies might be having a tough day, but the technology and innovation sectors are thriving. You understand that there are different stories playing out in different parts of the economy. You've just taken your first massive step from being a passive spectator to an active analyst. You've learned to read the scoreboards. But knowing the score of the game right now is only half the battle. What if you could see the key stats that tell you which team has the momentum? What if you could spot the signs that the game is about to turn before everyone else does? To do that, we have to move beyond the indexes and look at the market's vital signs. We need to explore the world of leading and lagging indicators, the secret numbers that can give us a glimpse into the future. That's where we're going next. Think of the economy as a patient and you're the doctor. Asking, "Is the stock market up today?" is like asking the patient, "So, how are you feeling right now?" The patient might say, "I feel fine." And the S&P 500 might be green. But a good doctor doesn't stop there. They take out their stethoscope, they check the blood pressure, they look at the lab results. They look for the vital signs that tell the real story. The story of what's happening beneath the surface, and more importantly, what might happen next. These economic vital signs are what we call indicators. And they come in two fundamental flavors. Lagging and leading is the most important distinction you can learn, and it's actually very simple. Lagging indicators are like looking in your car's rearview mirror. They tell you with great accuracy exactly where you've just been. Leading indicators are like looking through the windshield. They're trying to show you the road ahead, the curves, the hills, the potential traffic jams. Both are essential for a safe journey, but you have to know which one you're looking at. Let's start with the rearview mirror. Lagging indicators. These are the numbers that get all the headlines, but they're reporting on history. The most famous one is the unemployment rate. When you hear on the news that unemployment rose to 4%, that number isn't a prediction. It's a confirmation of a trend that started months ago. Think about it logically. A company doesn't lay off hundreds of people because they think business might get bad next quarter. They lay people off because business has already gotten bad. Sales have already dropped. Orders have already dried up. The decision to cut staff is a reaction to past and present pain. Then, the government takes time to collect all that data from across the country, compile it, and release the official report. By the time that number hits your screen, you're looking at a snapshot of the economy from weeks, or even months, ago. It's a crystal clear picture of the past. Another classic lagging indicator is corporate profits. Every 3 months, public companies are required to release their earnings reports. They tell the world how much money they made or lost in the previous quarter. This is incredibly valuable information. It's the ultimate report card. But again, it's a report on the past. When Apple reports record iPhone sales in the fourth quarter, They are telling you what happened between October and December. They are not telling you what will happen between January and March. It confirms a strong holiday season, but it doesn't predict a strong spring. Even inflation, measured by the Consumer Price Index or CPI, is largely a lagging indicator. The price hikes you see at the grocery store today are the end result of a long chain reaction. Supply chain disruptions that happened months ago, energy price spikes from the previous quarter, wage increases that were negotiated last year. The Federal Reserve sees this high inflation number and then raises interest rates to cool things down. They are reacting to the past. They are slamming the brakes because they see in the rearview mirror that they were just going way too fast. So if these numbers are all about the past, why do we even care? Why does the market freak out when the unemployment or inflation numbers are released? Because the rearview mirror provides confirmation and context. It's one thing to see storm clouds gathering on the horizon. That's a leading indicator. It's another thing entirely to look back and see the flattened town you just drove through. The lagging indicator confirms the storm was real, and it tells you exactly how destructive it was. It grounds our predictions in reality and helps us understand the true magnitude of what's happening. But if you want to avoid the storm altogether, you can't just stare in the rearview mirror. You have to look through the windshield. You need leading indicators. These are the secret numbers, the whispers in the data that try to predict the future. They are trickier, less certain, but infinitely more powerful if you know how to read them. One of the most powerful, and frankly, most mysterious leading indicators is something called the yield curve. Now, stay with me because this sounds complicated, but the idea is simple and brilliant. Normally, if you lend someone money, you expect to be paid more interest for a longer loan. A 10-year loan is riskier than a 2-year loan, so it should have a higher interest rate. That's a normal yield curve. But every so often, something weird happens. The curve inverts. The interest rate on a 2-year government bond becomes higher than the rate on a 10-year bond. Why on earth would that happen? It happens because the big players, the massive investment funds, the banks, the insurance companies are getting scared. They are so worried about the economy in the near future, say the next 1 or 2 years, that they start panic buying long-term safety. They all rush to lock their money away for 10 years in ultra-safe government bonds. This huge demand for 10-year bonds drives the interest rate on them down, down, down. At the same time, the Federal Reserve might be raising short-term rates to fight inflation. Suddenly the curve flips. This inverted yield curve is the market screaming that it sees a recession on the horizon. It's a collective vote of no confidence in the future, and its track record is terrifyingly accurate. An inverted yield curve has preceded every single U.S. recession for the past 50 years. It's not a guarantee, but it is perhaps the loudest alarm bell the economy has. A much simpler leading indicator to understand is building permits. Before you can build a new housing development, a factory, or a skyscraper, you have to get a permit from the local government. The number of new building permits issued is a direct look into the future of the construction industry. A surge in permits means that in the coming months, developers will be hiring armies of construction workers, buying tons of lumber, steel, and concrete, and ordering fleets of new trucks and equipment. It signals a wave of economic activity that hasn't happened yet, but is officially in the pipeline. It's a fantastic real-world clue about future growth and jobs. And here's a fun meta one for you. The stock market itself, the S&P 500, is considered a leading indicator. This seems circular, but it makes sense. A stock's price isn't based on what a company earned yesterday. It's based on what investors believe it will earn in the future. The entire stock market is a giant, chaotic, forward-looking machine. Millions of investors are placing bets every single second based on their hopes and fears for the next quarter, the next year, the next decade. When the market is rising, it reflects a collective optimism. When it's falling, it reflects a collective pessimism about future profits and economic growth. It's not always right, but it represents the aggregated wisdom and panic of the crowd looking ahead. So now we have these two sets of tools. We have our rearview mirror with lagging indicators like unemployment, giving us a confirmed history. And we have our windshield with leading indicators like the yield curve and building permits, giving us a foggy glimpse of the road ahead. The true art of reading the market isn't about picking one magic number. It's about being a detective, gathering clues from both the past and the potential future to build a coherent story. You see building permits fall off a cliff, a clue. Then you see the yield curve invert, a bigger clue. You start to form a theory. A slowdown is coming. Then, 6 months later, you see the unemployment numbers start to tick up and corporate profits miss their targets. That's your confirmation. The lagging indicators proved your leading indicators were right. But this raises a critical and much harder question. What happens when the clues contradict each other? What if building permits are soaring, but the yield curve is inverted? What if the stock market is hitting all-time highs, but manufacturing orders are plummeting? This is not a hypothetical. This happens all the time. You have one indicator screaming growth, while another is whispering recession. How do you know which signal to trust and which one is just noise? How do you weigh the evidence when it doesn't agree? To answer that, we need to go deeper. We need to understand the heartbeat of the economy itself, the business cycle. Think of the economy not as a machine, but as a living, breathing ecosystem. It has seasons. And just like the seasons of the year, these economic seasons follow a predictable, though not always perfectly timed, pattern. This pattern is the business cycle, and it's the master narrative that all those other indicators, GDP, unemployment, inflation, are just characters in. Understanding this cycle is like being given the map to a territory everyone else is trying to navigate blind. The cycle has 4 distinct phases. Let's call them spring, summer, autumn, and winter. Our story begins in spring. This is the early expansion phase. Imagine a town, let's call it Econoville, just emerging from a long, hard winter. The mood is cautiously optimistic. A few for sale signs on houses are being replaced with sold signs. The local hardware store owner notices he's selling more paint and lumber than he has in years. People are starting to fix up their homes. A small tech startup on the edge of town, one that barely survived the winter, just hired 2 new software engineers. They're not throwing a big party about it, but it's a start. In this economic spring, interest rates are low. It's cheap to borrow money. That hardware store owner can get a small business loan to expand his inventory. That young couple can finally afford the mortgage on their first home. Confidence is fragile but growing. People start spending a little more freely, not on luxuries but on necessities they've been putting off. They replace the 10-year-old washing machine. They finally get the car's transmission fixed. This new spending creates a ripple effect. The appliance store hires a new delivery driver. The auto mechanic can afford to take his family out to dinner. And the stock market? It's starting to thaw. It's not soaring yet, but it's quietly, steadily climbing a wall of worry. The headlines might still be gloomy, talking about the lingering effects of the winter, but smart money sees the green shoots. They know that this is the point of maximum opportunity. Buying into the market during the economic spring, when most people are still scared, is how generational wealth is often built. Then spring blossoms into summer. This is the late expansion phase, and it culminates in the peak of the cycle. In Econoville, the sun is shining. That small tech startup is now the town's largest employer, with a gleaming new office building. Construction cranes dot the skyline. There are now hiring signs in almost every window. Unemployment is incredibly low. If you want a job in Econoville during the summer, you can get one. Wages are rising as businesses compete for workers. People feel rich. They're not just buying new washing machines. They're remodeling their entire kitchens. They're buying new cars, boats, vacation homes. The local restaurants have a 2-hour wait on a Tuesday. This is the phase of euphoria. On the surface, everything looks perfect. GDP is growing strong. Corporate profits are soaring. But if you look closer, you can see the problem starting to brew. The cost of everything is going up. Lumber for those new houses is more expensive. The price of a burger at the local diner has been raised twice this year. This is inflation. The economy is starting to overheat like an engine running too fast for too long. The Federal Reserve, the country's central bank, starts to get nervous. They begin raising interest rates, trying to gently tap the brakes to cool things down without causing a crash. And the stock market in the summer? It's a full-blown party. Everyone is a stock market genius. Your Uber driver is giving you hot stock tips. People are borrowing money to pile into the market, convinced it can only go up. This is the point of maximum risk, yet it feels like the safest time to invest. The fear of missing out is far greater than the fear of losing money. The headlines are screaming about new all-time highs. But just as the longest day of summer marks the slow turn towards autumn, the economic peak is a moment of profound vulnerability. Then the first leaf falls. Autumn arrives. This is the contraction phase. In Econoville, the big tech company, citing rising costs and slowing demand, announces a hiring freeze. Then a month later, layoffs. The news sends a shockwave through the town. The construction projects are put on hold. Overtime hours at the factory are cut. That feeling of effortless prosperity vanishes, replaced by a knot of anxiety in everyone's stomach. People stop spending. The big-ticket items are the first to go. No one is remodeling their kitchen now. The car dealerships are suddenly empty. The 2-hour wait at the restaurant disappears. As people spend less, businesses see their profits shrink. This leads to more cost-cutting, more layoffs. It becomes a vicious downward spiral. One person's spending is another person's income. When that chain breaks, the whole system shudders. If this contraction is severe enough and lasts long enough, technically 2 consecutive quarters of falling GDP, it gets a name you know all too well: recession. This is the economic autumn. It's a time of reckoning. The bad investments made during the summer euphoria are exposed. Companies that took on too much debt go bankrupt. The stock market during this phase is brutal. It doesn't just drift down. It often falls off a cliff. Remember, the stock market is a leading indicator. It sniffed out the coming trouble before the layoffs were ever announced. That's when the yield curve inverted. That's when corporate insiders started selling their shares. For the average investor who bought in at the peak of the summer party, this phase is terrifying. Panic selling begins. People sell not because they want to, but because they have to, or because their fear becomes unbearable. The headlines are filled with words like plunge, crash, and crisis. Eventually, the falling leaves of autumn give way to the stark, cold reality of winter. This is the trough, the bottom of the cycle. In Econoville, things are grim. Unemployment is high. The gleaming new office building has entire floors sitting empty. The for lease signs are as common as the now hiring signs were in the summer. Foreclosed homes sit vacant. Confidence is completely shattered. The prevailing mood is one of despair. A belief that the good times will never return. Feels like an economic ice age. But beneath the frozen ground, something is happening. The excesses of the summer have been washed away. Asset prices, stocks, real estate are now cheap. The inflation that was raging during the summer has disappeared. In fact, prices might even be falling. In response to the crisis, the Federal Reserve has swung into action, aggressively cutting interest rates to near zero. It's incredibly cheap to borrow money again. The stock market in the winter is a wasteland. No one wants to touch it. The memory of the crash is too painful. Investing feels like the stupidest thing you could possibly do. But this moment of maximum pessimism is the secret. It's the mirror image of the summer's peak. This is the point of maximum opportunity disguised as maximum risk. It is in the depths of this economic winter that the seeds of the next spring are sown. A brave entrepreneur, seeing low costs and little competition, decides to start a new business. A young family, taking advantage of low home prices and rock-bottom mortgage rates, finally buys their dream house. Slowly, imperceptibly at first, the cycle begins again. This is the map. This is the rhythm of the economy. It's not a perfect clock. Sometimes summer is long and glorious. Sometimes winter is brutally harsh and drawn out. But the seasons always change. They always have, and they always will. The different economic indicators we talked about are simply the tools we use to figure out which season we're in, and which one is coming next. But this raises a critical question. We've seen the seasons change in Econoville, but who or what is controlling the weather? We mentioned the Federal Reserve tapping the brakes with interest rates. This isn't just some minor detail. It is the single most powerful force influencing these cycles. They are the ones with their hands on the thermostat of the entire U.S. economy. Understanding their goals, their tools, and their playbook is not optional for a serious investor. It is the key to anticipating the changing of the seasons before anyone else. So, who are these people? And how does one institution wield so much power over your money? The answer to that is where our journey takes us next. They are the Federal Reserve of the United States. And they are, without exaggeration, the single most powerful economic force on the planet. Forget presidents, forget Congress, forget billionaire CEOs. When it comes to the day-to-day, month-to-month direction of the stock market and the U.S. economy, all eyes are on a small group of economists and bankers who meet in a marble building in Washington, D.C. They are the unelected high priests of the American dollar, and their decisions create or destroy trillions of dollars in wealth with just a few carefully chosen words. To understand the market, you must first understand the Fed. So what is it? And why was it even created? To answer that, you have to picture America before 1913. It was the Wild West of banking. There was no central authority, no lender of last resort. When a bank got into trouble, it often failed, taking the savings of its customers with it. This created a domino effect. Fear would spread, people would rush to pull their money out of other banks, causing even healthy banks to collapse. These were called bank panics, and they were devastating, regularly plunging the nation into deep recessions. The Panic of 1907 was the last straw. It was so severe that the legendary banker J.P. Morgan himself had to personally step in and organize a bailout, effectively acting as a one-man central bank. The country's leaders realized this was no way to run a modern economy. They needed a permanent, institutional solution. And so, in 1913, the Federal Reserve was born. Its mission was to provide the nation with a safer, more flexible, and more stable monetary and financial system. At its head is a board of governors, appointed by the president and confirmed by the Senate. The most famous of these is the chair of the Federal Reserve, a name you'll hear constantly in financial news. Think Jerome Powell, Janet Yellen, Ben Bernanke, Alan Greenspan. When the Fed chair speaks, the entire world stops to listen. But the real power lies with a committee within the Fed called the Federal Open Market Committee, or the FOMC. This group, which includes the board of governors and presidents of the regional Federal Reserve banks, meets 8 times a year to decide the direction of the U.S. economy. And they do it primarily by wielding one incredibly powerful weapon: the control over interest rates. Now, interest rates is a term that gets thrown around so much it almost loses its meaning. But I want you to think of it in a very simple way. The interest rate set by the Fed is the base level cost of money in the entire country. It is the foundation upon which every other loan is built. Imagine the economy is a giant engine. To run, it needs fuel, in this case money. The Federal Reserve controls the main valve on that fuel line. The specific rate they control is called the federal funds rate. It's the rate banks charge each other for overnight loans to meet their reserve requirements. It sounds technical, but its effect is what matters. When the Fed lowers this rate, it's like opening the valve. Money becomes cheaper to borrow. Banks can lend to each other for less, which means they can lend to you and to businesses for less. Your mortgage rate goes down. Your car loan becomes more affordable. The interest on a business loan to build a new factory becomes cheaper. It's like pouring gasoline on the economic engine. People and companies are incentivized to borrow, spend, and invest. This stimulates growth, encourages hiring, and generally gets the economy humming. And what does a humming economy mean for the stock market? It means higher corporate profits, more optimistic forecasts, and rising stock prices. But what happens when the engine starts running too hot? What happens when everyone is spending, demand is outstripping supply, and prices for everything from gasoline to groceries start to skyrocket? This is inflation. And it is the Fed's greatest enemy. When inflation gets out of control, the Fed does the opposite. They step in and start closing the valve. They raise the federal funds rate. Money becomes more expensive. That foundational cost of borrowing goes up. Suddenly, your mortgage rate jumps. Your credit card's APR goes through the roof. The cost for a company to finance a new project becomes prohibitive. It's like pumping the brakes on the economy. The goal is to cool things down, to reduce spending just enough to bring prices back under control without slamming the economy into a recession. For the stock market, this is almost always bad news. Higher borrowing costs squeeze corporate profits. Consumers with less disposable income buy fewer products. The future looks less certain, and stock prices fall in anticipation of this slowdown. This reveals the Fed's core challenge, what's known as its dual mandate. By law, Congress has given the Fed 2 primary, and often conflicting goals: to achieve maximum employment and to maintain stable prices. Think of it like a tightrope walker. On one side, they have a pole labeled jobs. On the other, a pole labeled inflation. Their job is to walk across the tightrope of the economy, keeping both poles perfectly balanced. If they lean too far towards stimulating jobs by keeping rates too low for too long, the inflation pole will start to wobble, and they risk a dangerous spike in prices that hurts everyone's purchasing power. But if they lean too far towards fighting inflation by raising rates too high, too fast, the jobs pole will dip, and they risk throwing millions of people out of work and causing a recession. This is the drama that plays out every 6 weeks at those FOMC meetings. Every word in their official statements is scrutinized. Every answer the Fed chair gives in a press conference is analyzed by thousands of traders and algorithms in a fraction of a second. They are all trying to answer one question: which way is the tightrope walker about to lean? The market is a forward-looking machine. It doesn't just react to what the Fed does. It reacts to what it thinks the Fed is about to do. This has created a whole new language called Fed speak. Analysts will describe the Fed's tone as either hawkish or dovish. A hawkish Fed is aggressive, primarily concerned with fighting inflation. They sound like they're ready and willing to raise interest rates, even if it hurts the job market. A dovish Fed is the opposite. They sound more concerned with unemployment and are more likely to lower interest rates or keep them low to support the economy. Just a single word change in a statement, replacing some with considerable, for example, can send markets soaring or tumbling because it signals a subtle shift in their thinking. The greatest game on Wall Street is trying to get inside the heads of these 12 people on the FOMC. So when you hear on the news that the market is rallying on hopes of a Fed pivot, it means investors believe the Fed is about to shift from a hawkish rate-hiking stance to a more dovish rate-cutting one. When you hear the market fell after the Fed's hawkish comments, it means the chair said something that signaled they're going to keep their foot on the economic brake for longer than expected. The Fed, through its control of the cost of money and its carefully chosen language, sets the weather for the entire financial world. They decide if it's going to be sunny, allowing for growth and risk-taking, or if a storm is coming, forcing everyone to seek shelter. Understanding their dual mandate, their tools, and their language is the first giant leap toward understanding why the market moves the way it does on any given day. But what happens when simply turning the interest rate valve isn't enough? What happens when the economy is on life support like during the 2008 financial crisis, and the usual medicine won't work? That's when the Fed unleashes its financial bazooka, a tool so powerful and controversial, it has reshaped the very fabric of our financial world. And understanding that is the next critical piece of the puzzle. They call it quantitative easing, or just QE. And if that sounds like some impenetrable Wall Street jargon, stick with me because the basic idea is something you can feel in your gut. Imagine the economy is a giant, thirsty garden. For years, the Federal Reserve used its trusty watering can interest rates to keep things growing. A little more water here, a little less there. But in 2008, the garden wasn't just thirsty. It was a barren desert. The ground was cracked, the plants were withered, and the watering can was completely empty. Interest rates were already at zero. The Fed couldn't cut them any further. Yet, the entire system was grinding to a halt. Banks, terrified, stopped lending money to each other, let alone to you or me. Credit, the lifeblood of the economy, had frozen solid. This was not a normal downturn. This was a system-wide heart attack. So the Fed, with its traditional tools useless, did something unprecedented. It decided that if the watering can was empty, it was time to open the floodgates of a massive dam. This is quantitative easing. Instead of just tweaking the price of short-term borrowing, the Fed went into the open market and started buying things. Not stocks, but massive, colossal quantities of longer-term government bonds and another type of asset that was at the very heart of the crisis: mortgage-backed securities. Think of it this way. The Fed walked up to the big banks and said, "Give us those government bonds you're holding. Give us those toxic mortgage assets nobody wants to touch. In exchange, we will give you cash. Fresh, new digital cash." And here is the part that blows most people's minds. Where did the Fed get this money? Did it come from taxes? Did they borrow it from China? No, they created it. Literally, out of thin air. With a few keystrokes on a computer, the Federal Reserve credited the accounts of these commercial banks with billions, and eventually trillions, of brand new dollars. It was the digital equivalent of running a money printing press 24 hours a day, 7 days a week. The goal was twofold. First, by flooding the banks with all this new cash, the Fed hoped to unclog the financial plumbing. The idea was that a bank sitting on a mountain of fresh reserves would be far more likely to start lending again, to businesses that needed to make payroll, to families who wanted to buy a home. It was a system-wide liquidity injection, designed to fight the paralyzing fear that had gripped the market. The second goal was more subtle, but arguably even more powerful. Remember, the Fed was buying trillions of dollars worth of bonds. Basic economics tells you what happens when a huge new buyer with unlimited funds enters any market. Prices go up. So the price of these government bonds and mortgage-backed securities soared. And here's a fundamental rule of finance that is absolutely critical to understand. When the price of a bond goes up, its yield, or the interest rate it pays out, goes down. By buying all these bonds, the Fed was artificially forcing down long-term interest rates across the entire economy. Suddenly, the interest rate on a 30-year mortgage dropped to historic lows. The cost for a major corporation to borrow money for a new factory fell through the floor. The Fed was making money so cheap it was almost free, trying to entice everyone, from the biggest corporation to the smallest homebuyer, to start borrowing and spending again. So, how does this all connect back to the stock market? Why did the S&P 500, after crashing in 2008, embark on one of the longest and most explosive bull runs in history? It comes down to one of the most powerful acronyms on Wall Street over the last decade, TINA. It stands for, there is no alternative. Think like a big investor for a second. Your job is to make money for your clients, pension funds, retirement accounts, university endowments. For decades, a big part of your strategy was simple. You would put a large chunk of money in safe government bonds and collect a nice steady 4 or 5% interest every year. It was reliable. It was safe. But now, thanks to the Fed's QE program, those same bonds are paying maybe 1 or 2%. After you account for inflation, you're actually losing money. A savings account pays basically zero. So what do? Where do you put that money to get any kind of return? There is no alternative. But the stock market. Trillions of dollars that would have normally sat safely in the bond market were now forced to chase higher returns elsewhere. And the primary destination was stocks. This tidal wave of cash, desperately searching for a home, began pouring into companies like Apple, Amazon, and Google, pushing their prices to astronomical heights. It wasn't always because these companies' profits were growing at a record pace. It was because there was simply nowhere else for the money to go. TINA became the market's mantra. But that's only half the story. It wasn't just investors who were flush with cash. The companies themselves were borrowing money at the cheapest rates in history. And what did they do with that money? Yes, some of it went to building new factories and hiring new employees. But a huge chunk of it went into something called stock buybacks. A company uses its borrowed cash to buy its own shares off the open market. This does two things. First, it reduces the number of shares available, which automatically makes the remaining shares more valuable. Second, it creates a massive, constant buyer for the stock, artificially propping up its price. In essence, companies were using the Fed's cheap money to inflate their own stock prices. It was financial engineering on a grand scale, and it was rocket fuel for the bull market. For years, this seemed like a perfect solution. The stock market roared back to life, home prices recovered, and a full-blown depression was avoided. The Fed looked like heroes. But beneath the surface, this unprecedented experiment was creating deep and dangerous side effects. By pushing up the price of assets, stocks, bonds, real estate, QE overwhelmingly benefited the people who already owned those assets, the wealthy. While the average person's wages barely budged, the net worth of the richest 10% exploded. This has been one of the single biggest drivers of wealth inequality in modern American history. The gap between Wall Street and Main Street became a chasm. Furthermore, critics began to ask a terrifying question. Is any of this real? Did QE create a genuine, sustainable economic recovery? Or did it just inflate the biggest asset bubble in human history? When money is free, people stop worrying about risk. They pour money into unprofitable tech companies, cryptocurrencies with no intrinsic value, and speculative investments of all kinds. The market became a casino, powered by the Fed's printing press. And the most dangerous side effect of all? The market became an addict. It got hooked on the drug of easy money. The few times the Fed even hinted at slowing down its bond purchases, an event the market called the taper tantrum, stocks would immediately plunge. The system could no longer function without its fix. The Fed had created a monster it couldn't control. If they kept printing money, they risked runaway inflation and an even bigger bubble. If they stopped, they risked a catastrophic market crash. They were trapped. And for over a decade, they chose to keep the party going. But parties don't last forever. Eventually, the bill comes due. The Fed is now being forced to do the exact opposite of QE. They are trying to take the bazooka and put it into reverse, a process known as quantitative tightening. They are attempting to pull that ocean of money back out of the economy. So what happens when the tide goes out? What happens when the cheap money disappears and the market has to stand on its own 2 feet for the first time in over a decade? That's the terrifying question Wall Street is asking right now. And the answer is changing everything. The answer is you get a hangover. A decade-long, economy-wide, market-shattering hangover. The party of free money, 0% interest rates, and endless government stimulus is over. The music has stopped, the lights have come on, and we're all standing around looking at the mess. For 12 years, the Federal Reserve, America's central bank, kept the cost of borrowing money at or near zero. It was like giving the economy a permanent shot of adrenaline. If a company wanted to expand, it could borrow money for next to nothing. If a hedge fund wanted to make a massive bet, the financing was practically free. This environment created a very specific kind of stock market. A market that didn't care about profits today. It only cared about promises of profits tomorrow. Think about it. If you can borrow money for free, why would you invest in a slow, boring, but profitable company like a railroad or a utility? The real money was in the high-risk, high-reward bets. The disruptors. The tech startups with a great story, a charismatic CEO, and absolutely zero profit. Their business models were simple. Grow at all costs. Spend hundreds of millions of dollars to acquire customers, dominate a market, and worry about making money later. And for a decade it worked. Investors, flush with cheap cash and nowhere else to put it, threw money at these companies. Their stock prices soared into the stratosphere, not based on their earnings, but based on their potential. This was the era of growth investing, and it made a lot of people very, very rich. But then the monster awakened. Inflation. The side effect of all that free money and stimulus was that prices for everything from gasoline to groceries started to skyrocket. And the Federal Reserve has one primary job: to keep inflation under control. So they had to take away the punch bowl. They had to slam on the brakes. And their primary tool for doing that is raising interest rates. They started hiking rates at the fastest pace in 40 years. Suddenly, money wasn't free anymore. It was expensive. And that single change, the rising cost of money, completely shattered the foundation of the post-2008 stock market. The entire playbook that had worked for over a decade was thrown out the window. Remember, buy the dip? That mantra that anytime the market dropped, you should just blindly buy more because the Fed would always step in to save the day? That's gone. The Fed isn't your friend anymore. Its only goal is to kill inflation, even if it means causing pain in the stock market. In fact, a falling stock market helps them because it makes people feel less wealthy and spend less, which cools down the economy. So the Fed's safety net? It's been ripped to shreds. More importantly, the death of cheap money killed one of the most powerful forces in modern finance. TINA. It's an acronym that stands for There is no alternative. For years, because interest rates were so low, you earned basically nothing by putting your money in a savings account or a government bond. A one-year treasury bond might pay you 0.5%. A savings account? Maybe 0.01%. It was a joke. So if you wanted your money to grow at all, to beat inflation, you had no choice. You had to put it in the stock market. There was no alternative. TINA forced trillions of dollars into stocks, pushing prices ever higher, regardless of valuations. But now, TINA is dead and buried. As I'm talking to you right now, you can go buy a US government bond, one of the safest investments on planet Earth, and get paid a guaranteed 4 or 5% return. High-yield savings accounts are offering similar rates. Suddenly, there is an alternative. A very attractive, very safe alternative. Why would you risk your money on a speculative tech stock that has never turned a profit when you can get a guaranteed 5% return from the US government? You wouldn't. And big money managers, the pension funds and insurance companies that control trillions of dollars, are thinking the exact same thing. They're pulling money out of the risky parts of the market and putting it into the safety of bonds. This is a massive seismic shift in the flow of money, and it acts like a constant gravitational pull downwards on the stock market. So if the old rules are broken, what are the new rules? How do you read market trends in a world where everything has been turned upside down? You have to start watching a completely different set of signals. The game has changed from offense to defense, from chasing dreams to demanding reality. The first and most important signal in this new world is inflation. Every other number is secondary. The monthly Consumer Price Index, or CPI report, is now the Super Bowl for Wall Street. Before, nobody really cared. Now the entire market holds its breath waiting for that number, because that number dictates everything the Federal Reserve will do next. If inflation comes in higher than expected, the market tanks because it means the Fed will have to keep interest rates higher for longer, choking the economy. If inflation comes in lower than expected, the market soars because it signals that maybe, just maybe, the Fed can start to ease up. Forget earnings reports from your favorite company for a second. The single most important trend to follow for the overall market direction is the trend in inflation. Is it going down? Is it getting sticky? That is the question that moves trillions of dollars. The second major shift is the great rotation from growth to value. This is a classic market theme, but it hasn't mattered for over a decade. Now it's everything. Remember those unprofitable tech companies we talked about? Their stocks were priced based on a promise of distant future earnings. But when interest rates are high, $1 in the future is worth much less than $1 today. That complex math model that justified $1 billion valuation for a company losing money, it completely breaks when you plug in a 5% interest rate. Suddenly, those future promises look worthless. So where does the money go? It goes to value. It goes to the boring companies, the ones that make things people need to buy even in a recession. Think consumer staples like Procter & Gamble making toothpaste and toilet paper. Think big energy companies that are gushing cash. Think industrial giants and healthcare providers. These aren't exciting companies. They don't promise to change the world. But they do something that has suddenly become incredibly fashionable. They make actual money. Right now, they have real profits, they have strong cash flow, and they often pay you a dividend just for owning their stock. In a world of uncertainty, investors are no longer paying for stories. They are paying for cold hard cash. The trend is no longer about finding the next Tesla. It's about finding the companies that can survive a storm, the ones with a fortress-like balance sheet and a product nobody can live without. This is a brutal, unforgiving market environment. It punishes speculation and rewards prudence. It's a market where the fundamentals, actual sales, actual profits, actual cash, matter more than they have in a generation. The tide has gone out, and we're finally seeing who was swimming naked. The companies with no profits and mountains of debt are being exposed. The investors who were just betting on everything going up forever are getting wiped out. So the map of the market has been completely redrawn. The old landmarks are gone, and new ones have appeared. We know now that we have to watch inflation like a hawk. We know we need to focus on companies with real profits, not just exciting stories. But knowing the new rules of the road is only the first step. It's one thing to know you need to find a profitable, resilient company. It's another thing entirely to actually find one, and to know when to buy it. How do you look at a stock chart and separate a healthy trend from a dead cat bounce? How do you distinguish a truly strong company from one that just looks good on the surface? You need the tools to navigate this new terrain. You need to learn how to read the signals the market sends every single day, signals that are hidden in plain sight, on charts and in financial statements that most people find completely intimidating. And let's start with the single most intimidating thing for any new investor: the stock chart. It looks like a secret code, an EKG for money that only Wall Street insiders can decipher. But I'm going to let you in on a secret. A stock chart isn't a math problem. It's a story. It's a minute-by-minute, day-by-day record of a battle between buyers and sellers, between fear and greed, between hope and despair. And once you learn the language of that story, you can read it like a book. The most basic character in this story is called a candlestick. Forget the confusing lines and dots for a second. Let's just focus on one of these little red or green bars. Think of each candlestick as a summary of one round in a boxing match. Let's say we're looking at a daily chart. So each candlestick represents one full trading day. The thick part of the candle is called the body. This tells you where the stock's price opened at the start of the day, and where it closed at the end of the day. If the candle is green, it means the price closed higher than it opened. The buyers won that day's round. The stock went up. If the candle is red, it means the price closed lower than it opened. The sellers won that round. The stock went down. Simple, right? Green is good, red is bad. But then you have those skinny little lines sticking out of the top and bottom of the body. Those are called wicks or shadows. These tell you the full extent of the battle. The very top of the upper wick shows you the absolute highest price the stock hit during the day. And the very bottom of the lower wick shows you the absolute lowest price it hit. So a long upper wick on a red candle tells you a fascinating story. The buyers tried to push the price way up during the day, but by the closing bell, the sellers had shoved it all the way back down and then some. It was a failed rally. Hope was crushed. See, it's not just data. It's a drama. Every single candlestick is a miniature story of conflict. And when you string these stories together, day after day they form patterns. They reveal the market's psychology. This is where you gain a massive edge. The first and most important pattern to understand is the concept of support and resistance. These are the invisible floors and ceilings of the market. Support is a price level where a stock seems to stop falling. Think of it like a floor. The price comes down, hits this level, and then bounces back up. Why? Because at that specific price, buyers suddenly see a bargain. They rush in, overwhelming the sellers, and push the price higher. The more times a stock hits that floor and bounces, the stronger that support level is considered to be. Resistance is the exact opposite. It's a ceiling, a price level that a stock struggles to break through. It gets up to that price and suddenly sellers come out of the woodwork. They think the stock is overvalued, so they start selling, pushing the price back down. It's a psychological barrier where greed turns into fear. Why does this matter? Because a break of one of these levels is a huge signal. If a stock that has been bouncing off a support floor for months suddenly crashes right through it, that's a major sign of weakness. The dam has broken. Conversely, if a stock smashes through a long-held resistance ceiling, it's like a rocket breaking through the atmosphere. It's called a breakout, and it often signals the start of a powerful move higher. You're no longer guessing. You're seeing a fundamental shift in the battle between buyers and sellers. Now let's add another tool to make the trend even clearer. Moving averages. This sounds complicated, but it's not. A moving average simply smooths out the chaotic day-to-day price movements to show you the underlying trend. The two most famous are the 50-day and the 200-day moving averages. The 50-day shows you the medium-term trend, while the 200-day shows you the long-term trend. Here is one of the most powerful signals in all of finance, and you can see it with your own two eyes. When a stock's shorter-term trend starts to overtake its longer-term trend for the better, it's a huge sign of strength. Specifically, when the 50-day moving average crosses above the 200-day moving average, it's called a golden cross. This is a profoundly bullish signal. It tells you that not only is the stock doing well now, but its momentum is accelerating so fast that it's shifting the entire long-term picture. It's the market equivalent of a battleship slowly turning in a new direction. The opposite is just as powerful, and it has a much scarier name: the death cross. This happens when the 50-day moving average crosses below the 200-day moving average. It's a major bearish signal, suggesting that a long-term downtrend could be starting. These signals aren't foolproof. Nothing is. But they provide an incredible framework for understanding the health of a stock's trend. But there's a missing piece here. A chart pattern without this one ingredient is almost meaningless. That ingredient is volume. Volume is simply the number of shares traded in a given day. On the bottom of most stock charts, you'll see a series of vertical bars representing the daily volume. Think of volume as the emotional intensity behind a price move. It's the roar of the crowd. Imagine a stock breaks through a key resistance level. If it does so on very low volume, a small number of shares traded, it's like a single person whispering a rumor. It's not very convincing. Could easily be a fake out. But if that same stock smashes through that ceiling on massive, unusually high volume, that's the entire stadium roaring in agreement. That's a sign of conviction. Big institutions, hedge funds, the smart money, they are all piling in. High volume confirms the move. It validates the story the chart is telling you. Always look for volume. Now, this is where most technical analysis stops. But we're going to go one level deeper. Because a chart tells you what is happening, but it doesn't always tell you why. For that, we need to peek behind the curtain at the company's actual health. The story on the chart has to be backed up by a story in the real world. The single most important event for this is the company's quarterly earnings report. This is the company's report card, issued every 3 months. It's where they have to tell the world by law how their business is actually doing. You don't need to read the entire 100-page document. You just need to look for 2 key numbers to start. First, earnings per share or EPS. This is the bottom line. After all the bills are paid, how much profit did the company make for each share of its stock? More importantly, is that number growing? Is it higher than it was this time last year? Did it beat the expectations that Wall Street analysts had set? A company that is consistently growing its profits is a healthy company. Second, revenue. This is the top line. How much money did the company bring in from sales? Is that number growing? A company can cut costs to temporarily boost its profits, but you can't fake revenue. Growing revenue means the company is selling more of its products or services. It means customers want what they have. It's a sign of a vibrant, in-demand business. When you put these two worlds together, the chart and the earnings, that's when the magic happens. You might see a stock whose chart looks incredible, forming a perfect breakout pattern. But then you check their earnings, and you see that their revenue is shrinking and their profits are disappearing. The chart is telling a lie that the fundamentals will eventually expose. Conversely, you might find a company that just reported record-breaking revenue and explosive profit growth. You then look at its chart and see it just completed a golden cross on massive volume. Now you have a story that makes sense. The technical picture and the fundamental picture are in harmony. The roar of the crowd on the chart is being driven by the thunderous success of the actual business. This is how you develop real conviction. You're not just reading lines on a screen. You're understanding the engine that's making those lines move. You're moving from a gambler to an investigator. And now that you're an investigator, you need to learn how to read the evidence. The scene of the crime, the story of the company's stock. is written in a language that most people find intimidating. It's the language of charts. But I want you to stop thinking of a stock chart as a bunch of random jagged lines. That's a gambler's perspective. An investigator sees it for what it really is, a footprint. It's a detailed minute-by-minute diary of a massive psychological battle being fought between millions of people. Every single tick up is a victory for hope, greed, and optimism. Every tick down is a victory for fear, panic, and pessimism. A stock chart isn't a math problem. It's an EKG for market sentiment. It's a lie detector test for a company's hype. And once you learn to read it, you'll start to see the story unfold before your eyes. So, where does an investigator begin? You start with the most basic clues, the concepts of support and resistance. Imagine a tennis ball in a room. You drop it and it hits the floor. It bounces. The floor is the support. Now you throw it up and it hits the ceiling. It falls back down. The ceiling is the resistance. In the stock market, these aren't physical barriers, they are psychological ones. Support is a price level where so many buyers think, wow, this stock is a bargain at this price, that they swarm in and their buying pressure pushes the price back up. It's the floor. Resistance is a price level where so many existing owners think, okay, this is a great price to take my profits, that they start selling and their selling pressure pushes the price back down. It's the ceiling. For weeks or even months, a stock can bounce between this floor and this ceiling. The investigator watches this battle. You see the buyers defending the floor and the sellers defending the ceiling. But then something happens. News comes out, an earnings report surprises everyone, or a major shift in the industry occurs. Suddenly, a flood of new buyers enters the fight. They don't just push the price up to the ceiling, they smash right through it. This is called a breakout. It's a decisive victory. The old ceiling, that line of resistance, often becomes the new floor, the new level of support, as investors who missed the move now see any dip back to that price as a buying opportunity. The opposite is also true. If the price smashes through the floor of support, it's a breakdown, a capitulation by the buyers, and that old floor can become the new ceiling of resistance. Simply by drawing two horizontal lines on a chart, you can suddenly visualize the battlefield. You're no longer just seeing a price. You're seeing where the armies of buyers and sellers have decided to make their stand. Now, that gives you the horizontal picture. But what about the direction of the trend itself? For this, an investigator uses one of their most powerful tools, the moving average. Don't let the name scare you. It's incredibly simple. A 50-day moving average, for example, is just the average closing price of a stock over the last 50 days. That's it. So why is this so powerful? Because it acts like a filter. It smooths out all the chaotic, noisy day-to-day price swings and shows you the underlying smoothed-out consensus of where the price has been. It's the market center of gravity. Think of it as the true, underlying mood of the investors. There are two moving averages that are watched more than any others, the 50-day and the 200-day. The 50-day moving average is like the market's medium-term mood. If the stock price is consistently trading above its 50-day moving average, the general mood is positive. The trend is up. Buyers are in control. If the price is consistently trading below it, the mood is negative. The trend is down. Sellers are in control. The 200-day moving average is even more powerful. It's the long-term memory of the stock. It represents the consensus over roughly a year of trading. This is the line that big institutions, hedge funds, and pension funds watch. A stock trading above its 200-day moving average is considered to be in a major, long-term uptrend. It's seen as fundamentally healthy. A stock trading below it is seen as fundamentally unhealthy, in a major downtrend. When the price comes down and touches one of these major moving averages, it's a moment of truth. It's like the price is returning to its center of gravity to see if the trend is still valid. Often, these moving averages will act as dynamic support or resistance. In an uptrend, a stock will pull back to its 50-day moving average, find a wave of buyers waiting there, and bounce higher. As an investigator, you're not just guessing. You're seeing the trend confirm itself in real time. The most famous signals in all of finance come from these lines crossing. When the short-term mood, the 50-day, crosses above the long-term memory, the 200-day, it's called a golden cross. It's a powerfully bullish signal that suggests a new long-term uptrend may be starting. Conversely, when the 50-day crosses below the 200-day, it's called a death cross, a deeply bearish signal that the long-term trend has turned negative. These aren't magic. They work because millions of investors, from individuals to the biggest funds on Wall Street, are all watching these exact same lines. It becomes a self-fulfilling prophecy. So now you have the battlefield, support and resistance, and the underlying mood, moving averages. But there's one more crucial piece of evidence every investigator needs. A confession. In the market, the confession is volume. Volume is simply the number of shares traded in a given day. And it is the single best lie detector you have. Volume tells you how much conviction is behind a price move. Think of it this way: if one person says, "This stock is going up," it doesn't mean much. If a million people in a stadium all stand up and roar, "This stock is going up," you pay attention. A price move that happens on low volume is like a whisper. It's unconvincing. It could be random noise or a trap. But a price move that happens on huge massive volume is a shout. It's a statement of intent. When you see a stock smash through a resistance level, a breakout, you must immediately look at the volume. Was it a massive spike way above the average daily volume? If so, that's the market screaming that this is a real move. Big institutions are piling in. The conviction is real. But if that same breakout happens on weak, pathetic, below average volume, an investigator becomes suspicious. That could be a fake out, designed to lure in unsuspecting buyers before the price collapses again. Volume is the emotional energy behind the price. High volume on a down day signals panic. High volume on an up day signals euphoria. Low volume signals apathy and uncertainty. Without looking at volume, you're only reading half the story. You're seeing what happened, but you have no idea how many people cared. These three tools, support and resistance, moving averages and volume, are the foundation of reading any trend. They work together, confirming each other. You see a stock coming down to a major support level. At the same time, you notice it's also hitting its 200-day moving average, the market's long-term memory. And then, right at that point, it reverses and goes up on the biggest spike in volume you've seen in 3 months. That's not one clue. That's 3 separate pieces of evidence all pointing to the same conclusion. The buyers have taken a stand, and the uptrend is likely to continue. You're not gambling anymore. You're not guessing. You are building a case piece by piece, based on the evidence left behind by millions of people. You're reading the collective mind of the market. But here's the critical thing to understand. All of these tools are, by definition, looking at the past. They are lagging indicators. They show you what has happened and what is happening right now. They show you the mood of the crowd, but they don't necessarily tell you why the crowd is in that mood, or what the crowd is about to start looking at next. To truly get ahead of the trend, you need to move beyond reading the footprints and start looking at the horizon. You need to understand the economic forces that create the weather in which these battles are fought. And these economic forces aren't some abstract concept from a dusty textbook. They are the engine room of the entire market. They are the powerful deep currents that determine whether the tide is coming in or going out for everyone. If technical analysis is about reading the waves, understanding macroeconomics is about understanding the tide itself. And for most investors, there are 3 primary dials on the economic dashboard that you absolutely must keep an eye on. They are gross domestic product, inflation, and employment. Let's call them the big 3. First, let's talk about gross domestic product, or GDP. You hear this term thrown around on the news all the time, but what is it, really? Think of GDP as the country's ultimate report card. It's the total dollar value of all the goods and services produced within the United States over a specific time period, usually a quarter or a year. It's the price tag for the entire American economy. Now, why does this matter for your 401k? Because the stock market is, at its core, a collection of businesses. And businesses thrive when the economy is growing. When GDP is increasing, it means the overall economic pie is getting bigger. Companies are selling more, earning more, and expanding. That growth in corporate profits is the fundamental fuel that drives stock prices higher over the long term. Conversely, when GDP is shrinking for 2 consecutive quarters, that's the technical definition of a recession. The pie is getting smaller. Companies earn less, they lay people off, and investors get scared. That's a recipe for a bear market. But here's the secret the pros understand. It's not just about the number itself. The market is a forward-looking machine. It doesn't just react to the current GDP report. It reacts to how that report compares to expectations. If economists were predicting 2% growth and the report comes in at 3%, that's a huge positive surprise. The market will likely rally. But if they were expecting 2% growth and it comes in at 1%, that's a disappointment, and the market might sell off even though the economy still technically grew. It's all about the narrative and whether the story is getting better or worse than people thought. So when you see a GDP number, your first question shouldn't be, is it good? It should be, is it better or worse than expected? The second member of our big three is inflation. This one is personal. We all feel it at the gas pump and the grocery store. Inflation is simply the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. The most watched measure of this is the Consumer Price Index, or CPI. It tracks the average change in prices paid by urban consumers for a market basket of consumer goods and services. Now, inflation is a double-edged sword. A little bit of it, say around 2%, is actually considered healthy for an economy. It signals that demand is strong and it encourages people and businesses to spend or invest their money today rather than tomorrow, when it will be worth slightly less. It greases the wheels of the economy. The problem arises when inflation gets too high too fast. Think about a company like Ford. If the price of steel, rubber, and computer chips skyrockets, their costs go up. They can try to pass those costs on to you by raising the price of a new F-150, but at a certain point people will just stop buying. So, high inflation squeezes corporate profit margins from one end and crushes consumer demand from the other. It's a vice grip on the economy. And this is where the most powerful person in the financial world enters the picture: the chair of the Federal Reserve. The Fed has a dual mandate: to promote maximum employment and to maintain stable prices. When inflation runs hot, they are forced to act to fulfill that second mandate. Their primary tool? Interest rates. By raising interest rates, the Fed makes it more expensive for businesses to borrow money to expand and for consumers to borrow money for cars and homes. It's like gently tapping the brakes on the economy to cool it down and bring inflation back under control. For the stock market, rising interest rates are like kryptonite. They not only slow economic growth, but they also make safer investments, like government bonds, more attractive. Why risk your money in a volatile stock market when you can get a guaranteed, and now higher return from a bond? Money flows out of stocks and into bonds, pushing the market down. This dance between inflation data and the Federal Reserve's interest rate decisions is arguably the single most important drama to watch in the modern market. This brings us to the third and final member of the Big Three: employment. The monthly jobs report, specifically the non-farm payrolls number, is one of the most anticipated economic releases. It's a measure of the economy's heartbeat. It tells us how many jobs were created or lost in the previous month and what the unemployment rate is. The logic here is pretty straightforward. More people with jobs means more people with paychecks. More paychecks mean more consumer spending. And since consumer spending is the engine that drives roughly 2/3 of the U.S. economy, a strong labor market is a massive tailwind for corporate profits and therefore, stock prices. A report showing strong job growth is a clear sign of economic health. But, and this is a crucial piece of nuance in the world of market trends, sometimes good news can be bad news. How is that possible? Remember our discussion about inflation and the federal. If the jobs report is too strong, if job growth is explosive and wages are rising rapidly, the market can actually get scared. Why? Because a red-hot labor market can lead to wage inflation, which then fuels overall consumer price inflation. Investors will see a blockbuster jobs report and immediately think, oh no, this is going to force the Fed to raise interest rates even higher to cool things down. And so, paradoxically, a fantastic jobs number can sometimes trigger a market sell-off. It's this constant balancing act. The market wants job growth that is just right, strong enough to show the economy is healthy, but not so hot that it spooks the Federal Reserve. It's a Goldilocks scenario. So you have these three massive forces: GDP measuring the overall growth, inflation measuring the cost of that growth, and employment measuring the health of the consumer who powers that growth. They don't operate in a vacuum. They are all interconnected, and they all feed into the central question that every big money manager on Wall Street is asking every single day: what is the Federal Reserve going to do next? The market is a giant prediction engine, constantly trying to get ahead of the Fed's next move. Every piece of economic data, every GDP print, every CPI report, every jobs number, is instantly analyzed through this lens. Is this data point going to make the Fed more likely to raise rates, cut rates, or hold steady? That is the game. So how do you, as an individual, track this? You don't need a PhD in economics. You just need to know what to look for. You can find all this data for free on government websites like the Bureau of Economic Analysis and the Bureau of Labor Statistics. Better yet, use a free online economic calendar from any major financial news site. These calendars will tell you exactly when the next CPI report or jobs number is scheduled to be released. You'll notice that the market often gets very quiet and then extremely volatile in the minutes before and after these major announcements. Now you know why. It's the entire market holding its breath, waiting to see the new data that will shape the story of the economy for the next month. Your job isn't to react wildly to any single report. It's to see the trend. Is a series of inflation reports showing a steady decline? That's a powerful trend. Is job growth consistently surprising to the upside? That tells the story. By understanding these big three indicators, you're no longer just looking at the squiggly lines on a chart. You're understanding the fundamental weather patterns that cause those lines to move in the first place. You're moving from being a passenger tossed about by the waves to an observer who understands the tide. But even with this knowledge, there's one final crucial layer we need to peel back. We've looked at the charts, the technicals, the footprints of the big players. We've now looked at the macroeconomic data, the very weather that shapes the market landscape. But what drives the day-to-day, sometimes irrational swings in the market? What turns a simple correction into a full-blown panic? It's the one element we haven't discussed. Human emotion. It's the invisible hand that shoves prices to absurd highs, and the gut-wrenching force that pulls them into the abyss. Fear and greed. These two primal emotions are the twin engines of short-term market volatility. They are the ghosts in the machine. Greed is the siren song of easy money. It's the feeling you get when you see a stock up 20% in a week and you think, I need to get in on that. It's the fear of missing out, or FOMO, a term that has gone from internet slang to a legitimate market force. Greed is what inflates bubbles. It's what convinces otherwise rational people to pour their life savings into a company with no revenue, no product, and a catchy name, simply because the price is going up. During these periods of euphoria, fundamentals are irrelevant. Economic data is just background noise. The only thing that matters is the ticker, and the only color that matters is green. The story the market is telling is a fairy tale, and everyone wants to believe it will have a happy ending. They chase momentum, buying high with the hope of selling even higher, creating a self-fulfilling prophecy, until the music stops. And when it stops, fear takes the stage. Fear is a far more powerful, more visceral emotion. While greed builds slowly like a rising tide, fear strikes like a lightning bolt. It's the panic that sets in when you see your portfolio down 10% before lunch. It's the cold dread that whispers, this is it. This is the big one. Sell everything before it goes to zero. Fear is what turns a healthy correction into a devastating crash. It's a stampede for the exits, where everyone is trying to squeeze through the same small door at the same time. In these moments, value doesn't matter. A company could be trading for less than the cash it has in the bank, and fearful investors will still sell it, because they aren't thinking about value. They're thinking about survival. They aren't reading balance sheets. They're listening to the pounding of their own heart. This constant tug-of-war between fear and greed is so central to the market that there's even an index to measure it. The VIX, often called the Fear Index. The VIX measures the market's expectation of volatility over the next 30 days. When the VIX is low, the market is calm, complacent, maybe even a little greedy. When the VIX spikes, fear is in the driver's seat. It's a real-time sentiment gauge, a thermometer for the market's emotional state. Now think back to everything we've covered. Those technical chart patterns? They aren't mystical symbols. They are graphical representations of this battle. That resistance level on a chart is simply the price point where the collective fear of the sellers overwhelms the greed of the buyers. A support level is where the greed of the bargain hunters finally overpowers the panic of the sellers. A breakout is the moment one army definitively vanquishes the other. You're not just looking at lines on a screen, you're looking at a map of human psychology. And what about fundamental analysis? The bedrock of long-term value? In the short term, emotion can make a complete mockery of it. During the dot-com bubble, companies with no earnings were valued in the billions, pure, unadulterated greed. During the 2008 financial crisis, shares of some of the world's most profitable stable companies were sold off with the same terror as the banks that were actually failing, pure, indiscriminate fear. The economic data we talked about acts as the catalyst. A hot inflation report doesn't just mathematically alter a valuation model. It sparks fear of Fed rate hikes. A blowout jobs report doesn't just signal a strong economy. It can ignite greed as investors pile into stocks, expecting a boom. The data provides the news, but human emotion writes the headline. So after all this, after learning to read the tape, the charts, the economic calendar, and now the very sentiment of the crowd, what is the ultimate lesson? What is the secret to navigating this complex, chaotic, and often irrational world? It's this. The most important variable in your success is not the market. See you. The challenge is not to outsmart Wall Street or to find some secret formula that predicts every move. The challenge is to master yourself. It's to have the discipline to stick to your plan when the siren song of greed is calling you to chase a hot stock you know nothing about. It's to have the courage to hold on or even buy more when the terror of fear is screaming at you to sell everything at the bottom. This is why the most successful investors aren't necessarily the ones with the highest IQs, but the ones with the strongest stomachs. They understand that the market's emotional pendulum will always swing from euphoria to despair and back again. Their strategy is built on this understanding. They create a system, a set of rules and investment philosophy before the emotional storm hits. They decide why they are buying a stock, at what price they would consider it a bargain, and at what point their original thesis would be proven wrong. This plan becomes their anchor. It keeps them from being swept away by the emotional tides of the market. Warren Buffett famously said the key is to be fearful when others are greedy, and greedy when others are fearful. It's simple advice, but it's profoundly difficult to follow because it requires you to act directly against your own primal instincts and the deafening roar of the crowd. It requires you to buy when every fiber of your being is telling you to run, and to be cautious when everyone else is celebrating. So we come back to the question that started it all. Is the US stock market up today? We now know how to answer that question in incredible detail. We can look at the indexes, the sectors, the individual stocks. We can analyze the price action, the volume, the moving averages. We can cross-reference it with the latest CPI report, the jobs numbers, and the Fed's dot plot. We can even gauge the emotional temperature by looking at the VIX. But we also now understand that for most of us, this is the wrong question. Focus is on the noise, not the signal. The daily fluctuations, the dramatic headlines, the panicked sell-offs, and the euphoric rallies. This is the weather. It's intense, it's immediate, and it captures all of our attention. But what truly matters for building long-term wealth is the climate. The climate is the slow, powerful upward trend of the market over decades, driven by human innovation, population growth, and the relentless pursuit of progress. It's a trend that has persisted through wars, pandemics, recessions, and every crisis imaginable. Your job is not to perfectly predict the weather. No one can. Your job is to build a portfolio that is a sturdy, all-weather vessel. A vessel that can withstand the inevitable storms of fear, without getting blown off course by the tempting winds of greed. You started this journey asking a simple question about a single day, but you leave with the tools to understand the decades. You've learned that the market is more than just numbers on a screen. It is a dynamic, living entity. It's a complex interplay of logic and emotion, of data and drama, of fear and of greed. It is one of the greatest stories ever told, a real-time narrative of our collective hopes, fears, and ambitions for the future. And now you know how to read it.